Let's talk about the Bank of England and what they've done in the last couple of days, because it really is quite extraordinary. We've got two distinct things going on from the same institution. Remember, Monday, the Bank of England put out a statement saying that they're watching market action very, very closely, will not hesitate to act in order to bring inflation back to 2%. Now, that was a statement put out by the MPC committee. That is the committee that is traditionally tasked with raising interest rates, quantitative easing, etc., all in the name of its mandate. Its mandate, of course, is to bring inflation to 2 percentage points. So that was the announcement on Monday. Yesterday, we got another announcement from the FPC committee, that is the Financial Policy Committee, saying that they are starting buying up gilts again to the tune of about £5 billion a day for the next 13 days, so up to £65 billion, with the sole purpose of restoring market stability back again into the gilt market, the long end of the gilt curve, so that's 20-year plus. And the reason they did this is because after Friday, and up until Friday, we saw a sell-off in fixed income, quite large, but not on the scale that we saw post the budget announcement on Friday, which is when you really started to see these markets behave in a disorderly fashion. Gilt markets sold off 50 basis points on Friday, another 50 basis points on Monday. In terms of prices, we talked about this earlier, but some of these long-dated bonds actually halved in price. You're talking about, a 30-year gilt trading at 25 cents to the dollar. And these are really unprecedented moves. The Bank of England's FPC committee saw that happening and thought, well, this could be very destabilizing for the economy, namely because so many UK pension funds are invested in that part of the curve. About 1.5 trillion assets overall, 1 trillion pounds of which are invested into long-dated gilts and corporate bonds. So there was concern that this could lead into some sort of a negative feedback loop as the prices of these assets dropped. These pension funds would have to sell more to meet some of their margin calls. And the announcement yesterday was purely to step in to provide a couple of weeks of stability so that a more orderly market equilibrium could prevail. That was the rationale for the announcement yesterday. And the reason I'm walking you through all of this is because I've seen lots of commentators out there say, well, the Bank of England has thrown in the towel. They're the first central bank to give up. They've already walking back on their hiking stance, etc., etc. That is not what happened. It was, from their perspective, purely an announcement to come in and withdraw and support the gilt market, which was behaving in a very volatile fashion. But the onus is still going to be on the Bank of England at the November 3rd meeting to come up with rate hikes. And the interest rate market is pricing in now about 170 basis points of hike for that next meeting. Remember, last week they only hiked 50. We had that statement on Monday. We had the chief economist, Hugh Pill, come out on Tuesday saying that they would look to act significantly. So you probably need to see something north of 100 basis points in order for the markets, at least in the front end of the curve, to be reassured. So there are numerous things going on with the Bank of England right now. Number one, if you want to go in order, is headline inflation is almost 10%, 9.9 percentage points. We also have wage inflation running at 6 percentage points. Strictly monetary policy mandate, they need to hike rates to bring those inflation levels down. You also have a weakening currency. The currency is 20% cheaper. They need to hike rates to support the currency. You also have an expansionary fiscal stance. You need to hike rates to offset some of that expansionary fiscal stance. And so the onus is there on the Bank of England now to come in and support the market with all of these pressures that are coming through at a time when the government is trying to introduce tax cuts that are growth stimulative. And so the two things are going to offset one another. You have a Bank of England who have to hike aggressively, but it will come at the expense of growth. And this is where the issue lies, because monetary policy and fiscal policy are not acting in coordination with each other. They're actually clashing with one another, and that is the major problem. Just one final data point I want to lead you with. I think this is really interesting in the context of the gilt announcement yesterday. Gilts issuance is expected to reach a record high in the coming years after that budget was announced on Friday. About a third of the gilt market is owned by the Bank of England. Bank of England are no longer buying except for this stabilization measure in the next couple of weeks. They're supposed to be actually selling gilts come October the 31st. So you're losing one major buyer of the market. Add to that another third of the gilt market is owned by the international community. And the international community are saying, well, look, in order for us to get involved in the market, we need a much higher risk premium even with the weakness in the pound. So this issue about the gilt market being dysfunctional and illiquid is probably not going to go away in an environment where there's even more borrowing to come in the future as well.